chance.
Recording in progress.
Yeah.
Good morning. I'm calling to order the Equity Private Committee of the Board of Investments. It is 8 a.m. And at this point, Linda, would you provide instructions?
Yes, thank you, Mr. Santos. This meeting is being conducted as a virtual meeting and an in-person meeting. So I will do a roll call of the trustees to confirm attendance. Mr. Santos,
Present.
Mrs. Jones.
Good morning, present.
Thank you. Mr. Jones.
In auto, in transit.
Okay. Mr. Rue.
Yes, Mr. Jones can't participate.
Via telephone.
Mr. Rue. Ms. Sanchez.
Present.
Thank you. Mr. Green. Mr. Knox.
Good morning, I'm here.
Thank you. Mr. Kelly. Mr. Jason Green. Staff participating in the meeting include the following: CIO John Grable, Chief Counsel Stephen Rice, Investment Staff Esmeralda Del Bos and Jeff Gia, and guest speaker Reina Oberoi of Stanley Capital International. Trustees, please use the raise your hand option to be placed in the queue. At this time, you may ask all the meeting participants to mute their mics until you're ready to speak. And now we will proceed with the agenda.
Mr. Fila,
Yes.
would you take your seat, please? Thank you. The next item on the agenda, approval of the minutes.
It's actually the procedure for teleconference.
Okay, item number
Second.
2, procedure for teleconferencing. You want to provide that
So
instruction?
we don't have anybody that's participating except Ms. Sanchez.
Okay,
I'm participating by Brown Act.
Brown
Not
Act,
by-
correct. Not
yes.
by the AB 249.
okay, so now we can move to the approval of the minutes.
Yes.
All right, item 3, approval of the minutes. Any changes, corrections? Hearing none, I will entertain a motion.
Just
move
one
it.
second. Let me just approval of the minutes. Okay, so Mr. Santos moved it. Second?
Second.
Okay. Okay,
It's been moved and second. Roll call, please.
Mr. Santos?
Yes.
Mrs. Jones?
Aye.
And Ms. Sanchez?
Aye.
Okay, the motion passes.
Great, thank you. Next item is public comment. Have we received any requests for speak?
No.
To speak? I don't see anybody stepping up. Moving forward, item 5, reports. Mr. Bosque, good morning, madam. How
Good
are you?
morning.
Good to see you.
Very well, thank you. Good morning, Chair Santos, members of the committee and trustees. The Global Equity Team has worked with Morgan Stanley Capital International, known as MSCI, to provide education on its all-country world investable market index, also known as the ACWI IMI. The ACWI IMI combines both developed and emerging market publicly traded stocks and is the basis for the board-approved policy index for both the global equity and private equity asset classes, whose combined assets are roughly 50% of the total fund. Now, to further underscore the importance of this specific benchmark, the MSCI ACWI IMI is used to measure the performance, attribution, portfolio exposures, including sector and country weights, as well as investment risk for both the private equity and global equity portfolios. We're happy to have Ms. Reina Oberoi, Managing Director and Global Head of Equity Solutions Research at MSCI, to provide today's educational session. She's going to start off with a brief introduction on the MSCI index business and then quickly launch into how the ACWI is constructed, as well as provide characteristics on the index so you can familiarize yourselves with it more, as well as describe MSCI's consultation process using 2 case studies. First, the growing inclusion of China within the index, and second, the recent delisting of Russia. Ms. Oberoi's full biography is in the appendix of your package. But prior to giving Ms. Oberoi the floor, my colleague Jeff Gia will provide a brief overview of the LACERA assets benchmarked to the MSCI ACWI IMI.
Good morning, Mr. Jia.
Morning.
Neglected to provide your greetings this morning, so my apologies.
Thank you. Thank you, Esme, and thank you, Krista, for driving the slide today. Can we have the slide up? Thank you. Good morning, committee chair and trustees. Just to echo Esme, the MSCI ACWI IMI index is important for the management of the growth portfolio functional asset category. To help set the stage, we thought it might be beneficial to provide this slide for the committee. The pie chart on the left-hand side shows the breakdown of growth, which was at 36 billion as of last year end, or approximately 50% of the total fund. For the benefit of new trustees, per our investment policy statement and structure review, growth investments are the primary driver of long-term total fund returns. Within growth, the role of global equity is primarily expected to provide market beta exposure with excess return as a secondary consideration. And private equity is expected to generate the highest performance at an acceptable level of risk. While it is important to note that both global equity and private equity are measured against the MSCI ACWI IMI index, the private equity is benchmarked to the index plus a 200 basis point return hurdle to reflect its role in growth. In total, both assets account for approximately 97% of the growth portfolio. Now, if I can direct your attention to the pie chart on the right-hand side, this shows the breakdown by strategy of the global equity portfolio. which is constructed based purely on the MSCI ACWI IMI index. The passive index, which represents 65% of the total global equity portfolio, is directly modeled on the MSCI ACWI IMI index through a separately managed account. To reiterate the point again, almost 50% of LACERA's total fund is managed to the MSCI ACWI IMI index. So it is crucial to understand the index, its methodology, and its exposures. With that, I'll pass the presentation over to Ms. Oberoi from MSCI.
Hi, everyone. Thank you for having me. It's a pleasure to be here. Let's dive right in. Just introduce you to who MSCI is. As many of you may be aware, MSCI is a provider of critical decision investment tools to help clients build portfolios confidently and to be able to understand the drivers of risk and return. It is really our role over the years to bring transparency into the investment process as much as possible, especially as the growing role of indexes increase in the investment process. Now, with over 50 years of partnership and between research, technology, and data, our focus has been on really driving this transparency and helping clients build these resilient portfolios. Now let's take a step back and just focus on the index business, which is a flagship business for MSCI. And MSCI again has been in this business and building indexes for the last 50 years. That has naturally evolved, but maybe we can go to the next slide and we can focus a little bit on the next one. Oops, yeah, that's good. So, the idea here is that there is an index for every portfolio, which means that whatever your investment goals are, and every individual investor, every institutional investor can have different investment goals. And indexes essentially are designed to capture those investment goals and are evolving over time to be able to be representative of that opportunity set. The goal of indexes is to be transparent. And really, so whatever your goal is, if your goal is diversification, if your goal is differentiation, if your goal is decarbonization, or just being exposed to the investable opportunity set, it's extremely important that the indexes have accurate data, which is quality checked. The index rules are highly predictable. And at the same time, there is an ongoing evolution and innovation in the index processes and what indexes aim to capture. And as we've gone through these decades of investment, the role of indexes has evolved, as well as the goals that they try to help achieve have also evolved. So you have a lot more today, some levels of customizations that reflect individual client views or institutional client views, but at the same time have this solid bedrock of foundation that has been created over the years and the credibility that has been created over the years with index methodology and construction. Next slide, please. All right, so MSCI does have a lot of indexes. I think for this session, we are just going to focus on the MSCI ACWI IMI index, which, as mentioned before, is the All Country World Index, and IMI stands for Investable Market Index. And what this index really is encompasses developed markets, plus emerging markets, and then large, mid, and small cap companies. The role of this index and this framework is to provide investors the maximum and the most comprehensive equity opportunity set that is investable and transparent in terms for portfolio construction and asset allocation. Now, as you look at this chart here, you can see that there is these little building blocks, if you will. And the reason for these building blocks is that the way ACWI IMI is constructed, it's a very modular approach. So you can drill down into developed markets, emerging markets, countries, sectors, or you could go back up and build it all the way, aggregate up to the ACWI IMI. So it's a very consistent framework. There are no gaps and overlaps in this framework. And what that helps you do is really understand what is your equity allocation today and how that might evolve, and gives you a really transparent picture and a consistent way of looking at how much is developed markets, how much is emerging markets, what are some sectors, what are some country bets, what are some large, mid, and small cap bets. So those are the exposures that you can very clearly see today. And then as a committee also decide in the future if you were to evolve that exposure as you go along in terms of your investment roadmap. Next slide, please. You can go on, yes. So now I would like to spend a little bit of time on the MSCI index process. And this is crucial and vital for any index provider, in particular MSCI, because we do take a lot of pride in the robust governance and the oversight that we provide to this process and help the process maintain its integrity. So some of the key cornerstones of this process are having a unique methodology. Now, by saying it's a unique methodology, it doesn't mean that it is available only to certain clients. It doesn't mean that it's something which is very secretive. It's actually something which is very transparent. It's rules-based. It's consistent, available to all clients and publicly. And that is really the role of index providers, to bring that transparency. And as a result, having these methodologies that are transparent and replicable and represent an investable opportunity set is extremely crucial as a foundation of any index construction process. The second pillar is, how do we manage these indexes? How do we manage the research behind it? How do we manage what's going in and out of the index? What is the methodology? What is the process around that? So we obviously have a dedicated research team across the globe that focuses on different aspects of index construction. But then we also have independent committees that are then reviewing the output of these decisions and these analyses to have a more objective oversight in the process and to make sure that we are being reflective of the equity evolution, as well as being very fair to clients in terms of our processes, in terms of the way things are announced. Are all clients getting the announcement at the same time? Is there any sort of conflict of interest? Is everyone being treated fairly? Last but not the least, we as index providers, we take our role very seriously, where we are one of the players in the ecosystem. What we do is we help with the design of the index, because we want it to reflect the equity opportunity set. Now, if there is a situation where we feel that this is not reflective of the market today, those are situations where we look to clients like yourself in a robust consultation to be able to get feedback in terms of, as practitioners, what are you seeing? And that is a cornerstone of our methodology as well, that no decision in terms of methodology change or in terms of a significant implication of our index construction is made without consulting our clients globally and a wide group of clients, whether it's asset owners, asset managers, broker dealers, ETF providers, and honestly from the largest client to the smallest client, because we want to make sure everyone who is using our indexes is able to replicate them, is able to understand them in a coherent fashion. Next slide, please. So index construction, has an impact and matters. Now, there are different ways why index construction can matter and why it is really, really important to actually understand that process. And every index provider may have their own way of explaining it, but for us, the index drives performance. And if you are not correctly reflecting changes in your index, if there are errors, if there are things that are added and deleted and you have traded them, and then we have had to add it back, that is a direct cost to the client. That is also an error in terms of the way we look at the performance of a particular market, and it's not reflective of that particular market. So, the idea is that the index construction should be transparent, rules-based, but also really accurate, so that any client who's trying to replicate this index or track this index is able to do that in the most cost-efficient fashion and not at the cost of any errors that have happened by the index provider. Even in terms of the methodology, if you think about it, any index provider, if we are creating indexes on these different regions, we have, deep knowledge about these markets. We have teams that are focused on understanding these markets. We obviously have been in this business for 50 plus years. We also want to make sure that we are covering the broadest opportunity set in terms of investments for our clients. And again, as I mentioned, the accuracy level becomes really key here, as well as the way the index is constructed. Now, turnover is really when things are going in and out of the index or weights are increasing or decreasing. Anything that causes a churn in the index causes turnover. And by turnover means you have to trade more, and that is a direct cost to replicating or tracking the index for the client. And those are things that we have to manage constantly as we think about our process, as we review our methodologies and review our results of our rebalances and index changes. Next slide, please. So here I'm going to quickly cover how we construct our ACWI IMI indexes. And as you can tell, in the first step, there are a host of securities. There are tens of thousands of equity securities out there. And naturally, all of them are not investable. So first, what we do is we screen out eligible types of securities that are actually investable and make sense to be a part of a broad equity universe. So this is the broadest equity universe. And then the way we look at our classifications, we look at one company belongs to one country. And as a result, it belongs to developed markets or emerging markets. It also belongs to only one sector. So we don't have overlapping categorization. And why this is important is because it helps with a very clear way of thinking about asset allocation and the consistency and framework that I mentioned earlier. Another very important step is making sure this universe is liquid and is investable. And there are a few criteria that we use to determine that. We have a few liquidity screens that we look at the security level and make sure that these companies are appropriately liquid for their market and for their region. And we also look at, especially for international companies, we also look at their float. And what the float really is how much of a company's shares is publicly available for the average investor to trade, and how much of those shares are held by insiders or by folks who are part of the committee or part of the board or part of the company who will probably not be selling those shares, and those are considered as non-float. So it's really important to understand the difference between float and non-float, and float is what we focus on because that is what will be available for the investor to be able to replicate an index.
So so let's say a Chinese company that the Chinese government has invested substantial in that company. Is that reflected?
Yes.
So
government stakes would be considered non-float.
Non-float.
Yes.
Thank you.
Yes.
And by the way, for my colleagues, anybody who has a question, please raise their hand. More than happy to acquiesce. Thank you, ma'am.
Yeah, sure. So that is, at a high level in terms of liquidity, investability. And, again, to your point on float, actually, one of the things that is even more granular that we go into is that, let's say a company says 50% of my shares are publicly available. But then let's say, out of that, a lot of it is already held by some investors. And they have non-float, they are float shares, but they're already held. So now if someone else wants to come into it, is there foreign room for them to actually come into that share, which is float? So we have a float level, and then within that, we have within the float, how much is actually available for clients to be able to actually invest. Okay, sorry, next, let me just finish one or two things, then we can move on to, I know we have a lot to cover. And then once we figure out the liquidity and investability, what we then do is for each market, we essentially rank them by market cap, these companies, and then figure out which are the companies that are going to be in the large cap segment or the standard segment, which consists of large and mid, and which companies are going to be in the small cap segment. So this way we cover 99% of the opportunity set of every underlying market within ACWI IMI. And then, this again, once we create these markets, this can be used in ways to combine for certain regions. It can be used as building blocks. It can be aggregated all the way up to ACWI IMI, or ACWI IMI can be broken down, in different shapes or forms. So this is really the modular approach that I was talking about earlier. Next slide, please. So here, this is just, I think this section, I will move on a little more quickly because this is just to show you the breakdown of ACWI IMI. And as you can see, developed markets today is 89% and emerging markets is 11%. This has evolved over the years. In the last 3 decades, emerging markets was 6%, 7%. That over the years has become, more and more. But developed markets has always been the majority of the ACWI IMI framework. And as you can see, there are 23 developed markets that we cover and 24 emerging markets in our ACWI IMI framework.
Is China a developed market or emerging market?
Emerging market.
Still?
Yes.
What criteria is used to determine whether or not a particular country is developed?
Yes, sure. So we have something called a market classification framework, which we publish. It's the rules are public in terms of the criteria for every country, and there are 3 broad criteria that are used to determine where a country may fall in. And typically, economic development is kind of one, which is again sourced by global national product and from the World Bank. The second is the size of companies, the liquidity of those securities. And then third is something called market accessibility, which is extremely key. We use 5 different categories and 18 criteria to determine how accessible is the market. And I will cover a little bit of that as we go into the China case study. But how can I take my money in and out? Can I easily open an account? Is it transparent? And all of those things. So that's why for us, China, and we actually come up with rating where we rate each category for China and for every country. And we actually release that report every year in June to show you which countries are where in the spectrum in terms of all these criteria. Okay, next slide, please.
Thank you.
Once again here, this is just to show you the developed markets breakdown. And as you can see, it is quite dominated by North America and especially the US. And US has always hovered around being the majority component here. But again, we try to be as transparent in terms of which countries go into developed markets, just again based on that market classification framework that I mentioned. Next slide, please. Here we have the emerging markets breakdown, and as you can see here, China is the dominant country in emerging markets. We also have Latin America, which is has smaller countries in there, but is a growing portion of emerging markets. And then Africa, which again we don't carve it out as a region, but you can see in the EMEA section, it's really South Africa and Egypt that we would consider part of Africa. And then a lot of the African countries actually come under frontier markets. So there are about 13 countries that come under Africa, like Kenya, Senegal, etc. But they are in frontier markets and they don't have their presence in emerging markets. Next slide, please. This is just to give you a sense of what are the top 10 countries in the MSCI ACWI IMI. And here, the only 2 emerging markets that are there are actually China and India. And again, from an investability standpoint, the reason these are represented is because they make up a significant portion of the global opportunity set. They provide the diversification, and that as a result, and they also provide an engine of growth in terms of just overall allocations and overall economic growth, as well as growth in equities. As a result, they are naturally a part of these top 10. But it's not that we've picked these top 10. These top 10 are just based on weights of those countries and the representation of those countries in the overall ACWI IMI index. Next slide, please. Here, I'm just going to quickly point out, just on the right, just to think about what are the top 10 holdings. And as you can see, some still pretty tech-heavy names, such as Apple, Microsoft, which are at 3.3 and 2.7% respectively, that still dominate, ACWI IMI. And this again, has come down, a fair bit, given there's been kind of a drawdown in tech and decline in tech stocks. But broadly speaking, these are the top 10 names in ACWI IMI as of December 31st, 2022. Next slide, please. Okay, so let's start with the consultation process of MSCI and use China as a case study. I'm not going to spend too much time on this slide in the interest of time, but the purpose of this slide is really to show what are some of the benchmark best practices that help you as clients, achieve accuracy, are able to replicate our indexes. Our indexes are investable, they become cost effective, and they have to be fair to all investors. And in addition to kind of robust governance, having accurate methodologies, accurate data, having publicly available documents available, and continuous innovation, a broad comprehensive consultation on any topic is really key. And by broad, as I said, it means the biggest client or the smallest client across the group in terms of different client types, to make sure that we are incorporating their experiences and their feedback in our decision making. Next slide, please. So this is the market accessibility framework that I was talking about earlier, where we look at 5 categories to figure out which country, how countries rank in terms of the accessibility for foreign investors. And within these 5 categories, we have 18 different criteria. I'll quickly go over them, but for something that we took a look at for China as well is across these 5 criteria. How open is the country to foreign investors in terms of float, in terms of foreign room, in terms of being fair to foreign investors? How easily can you get your money out of a country in terms of capital inflows and outflows? How easy is it to open an account, clearance, settlement, and just availability of instruments to hedge your exposures, and just the overall stability of the country in terms of when things like crisis happens, how do we view that country, and the stability of the institutional framework in terms of government intervention. So those are some of the things that we look at regardless, and we've looked at for China as well, as we have started the inclusion process of China in the MSCI Emerging Markets Index.
So what about accounting rules? I mean, I understand, I don't know if it's true today or not, but at some point, there were allegations that typically a company, Chinese company, will have 3 set of books. One that the CEO will provide to the wife, one that they provide to the government, and then the other one was a private. So is that still the case? Have you heard that?
So I think the transparency is extremely important, and if we are not able to, so we have a team in China, and if we are not able to validate any of the data that has been filed publicly by the authorities, and especially for the U.S. market, it's something that U.S. investors also want to understand how this is being done, then we would not consider that company for inclusion. For example, if there's any doubt in terms of where the data is coming from, it has to be a public official source, such as company filings, but company filings in the sense that it has to be done with authorities and be reviewed as not opposed to just a simple document or like a slide deck saying this is what we do, right? So I think our IP is our team, local teams that understand the local languages, as well as verify that in publicly international available documents.
Great, thank you very much. If you give me a minute, Mr. Jones, feel free to come in and take your seat here. I want to make sure you have the opportunity to ask any questions you deem appropriate. Yes, ma'am. Oh, Mr. Knox.
Are you done with your
Yes, sir.
question? Thank you. The ease of capital inflows and outflows, is that just measuring statistics, dollars, or is it evaluating the mechanisms to transfer those monies in and out?
Yeah, it's evaluating the mechanism. Like what are the inflows, what are the inflows and outflows right now? Is it coming from at the government level, or is it coming at a certain account level? For example, if you recall, China had these qualified quotas for institutional investors, where only institutional investors who had these qualified quotas could invest in China. They have over the years, made that process easier, and now we actually have a kind of a trading system called the Stock Connect, where you can actually just go and trade instead of actually applying for a quota, which takes months, and then you may or may not get that quota. So then that becomes a restriction in terms of capital inflow. That you cannot really put money into the market unless you have a quota, and that's differentiates one investor from the other, because some large investors might be able to get a quota versus others. So those are things that we had flagged earlier in terms of our inclusion process for China as a part of emerging markets, because everyone should be able to invest in that country then.
So then some of it is an evaluation of the difficulty of moving money in and out. And then another piece of that is evaluating the risk of trying to get it out, or.
So I think that would be, the mechanisms is something that we are aware of, but obviously the risk of, let's say we say the mechanism is all clear and we come to you and we say, what is your experience? You're like, I'm concerned because I'm not sure. And those are the things where the consultation process really matters, because we would understand that perhaps on paper, this looks good, but in practicality, you have some concerns and you want to make sure we are addressing that, right? So those are things, it's a little bit of a kind of a rules-based approach, but a lot of it is hearing from our clients in terms of their experience.
Well, thank you. Thank you, Mr. Chair.
Yeah. All right, so we can go on to the next slide. And in the interest of time, I might just skip this slide. Just talks about how China has been obviously contributing to global growth significantly. But I think the next slide might be something which is a little more interesting. So here, what we talk about is there's obviously things that have improved in China over time. MSCI decided to include China in the emerging markets index after 4 years of consultation. So we announced a consultation in 2013 for China A, not specifically China, but China A, which is the domestic market shares, which were not accessible to foreign investors. And we finally included it in 2018. So as you can see, it took a while before we actually were comfortable that this is, these are shares that are accessible by everyone across the globe. And then further, we kind of evaluated that, and that was only at the 5% inclusion level. So we just included 5% of what could have been included. And then we stepped that up to 20% the following year after hearing feedback again that yes, the market had become more accessible and there were more rules in place for investors to be able to easily access this market. Now, we have not included China more than to 20% because we have certain pending items that we want to see improve before we can go down that route. There are some emerging risks that are coming in from China, as we've seen in terms of the COVID lockdown that happened, and that obviously has hampered China's growth. There's also some perception of like a decoupling risk, especially as we think about the trade wars and some of the geopolitical tensions that are happening. So those are things that are emerging and are on our radar as well as on the radar of our clients. Next slide, please.
Mr. Jones?
Yeah, sorry to
No worries.
have been late through here. So question on, and this may link a little bit to decoupling. I was listening to one of the analysts on CNBC talking the other day about capitalism with Chinese characteristics, and that has always been kind of at least the theme to the West, where we've embraced the capitalism part with cheer, but have spent little time perhaps understanding what Chinese characteristics means. Now seeing where Ping and the CCP seems to be going, are the characteristics that have typically kind of defined the opportunity there. Where do you see that going? I saw the 5-year goal statement kind of come out through there. I can't tell at some level if we're whistling in the dark, hoping that, things stay somewhat like they've been or how we anticipated in the initial opening, or do you see things taking a more definitive turn towards more political involvement and and things in the economy, and then how do you define that? How you measure that as risk? Where do we capture that as risk within that country? You understand why?
Yeah, so I think those risks would come under, a few things. So regulations. So if we go back to, let me see what slide that is. If you just go back a couple of slides. Yeah, that one. So in terms of, those risks would get captured across these areas. So if you think about openness to foreign ownership, if we feel like foreigners are not being treated fairly like the domestic investors, and it's becoming more challenging for them to operate accounts in China. Those are risks that will be measured there. In terms of just the stability of the institutional framework is when we think about, how would governments manage a situation in times of crisis, and the ability to be able to actually repatriate your money, even if there's a crisis. Is that something that's still possible in a very seamless fashion? So I would say, like, across all these 5 categories, those risks would get captured in terms of where it's headed. Now, where China is headed, that's obviously something that, everyone's waiting to watch, and we are also waiting to watch, and we're going to rely on our clients to be able to tell us, what their experience is. And, our role is really to represent China in the global opportunity set, as and when it makes sense, and if it is a part of an investment universe. If it does not make sense and it's not a part of the investment universe, then we just pause and see how things shape up.
Good, thank you.
All right. Okay.
I have a follow-on question to that.
Go ahead.
Oh, yeah, of course. Madam Chair.
Thank you. So I'm going to just expand that kind of concept of stranded asset risk a little more broadly to the kind of continuing geopolitical tension that seems to be increasing in the world, and quite frankly, political stability, which was potentially an issue in China, but is also kind of a storyline that could play out in other parts of the world. Can you talk a little bit about sort of how those harder to quantify elements of potential for stranded assets, because obviously I think your goal is ultimately to in creating the investable index is to help protect clients from this stranded asset risk. Can you talk a little bit about how you're dealing with these emergent geopolitical and social stability issues that are cropping up not only in Asia but also in other parts of the world?
Yeah, absolutely. So, we are obviously, talking to our clients who, again, some, depends on, which way the wind blows, but there'll be clients who will say we have no problem investing in China. And for the most part, we are seeing that. And there are others who are like, we may take a pause and see what, keep our current allocations, but not do anything more because we want to watch. So as a result, for us, it's, really kind of making sure we are taking the view of the investment community in terms of that. Now, in terms of, the stranded assets, now we would never include something or increase the weight of China in an index without having full consensus. So what we are trying to avoid is that do something and then have to, take a step back and undo our decision. So that's, that's the extent to which, we are being very slow and measured about how we approach this. We obviously have, other data sets and tools such as, governance of countries, governance of companies. We evaluate that. We evaluate environment, social, and governance characteristics. So those also give us a lot of insight in terms of what the companies are doing, and across the board, not only China. And we can make decisions based on that and get some more transparency at that granular level too, as opposed to just at the equity market level.
Thank you.
Sure. Okay, we can move on. Yes. So I'm just going to spend probably a minute on this slide. But as you can tell on the top left chart, China today is, roughly about 32% of, the EM index, the MSCI Emerging Markets Index. And That's at the 20% inclusion level. Now, if we were to fully include China, which is the hypothetical, and MSCI again has not committed to any sort of further inclusion, China would become 44% of the emerging markets index. So it would really dominate the index. And then if you just think about the China, the China A component, which are the domestic shares that we started including in 2018, we 16% of the MSCI China index, and at full inclusion, it will go to almost 50% of the China index. So that's how huge the domestic market is. That's why investors globally are keen to tap that market, because there is obviously a lot of opportunity and growth there. But at the same time, we want to be measured to make sure that this market is investable and investors have fair access to this market and are protected in terms of index investments. Okay, next slide, please. So in terms of, there was one question that, what are some of the things that are still pending for China? And again, these are things that we evaluate every year. In the summer, we come up with a report called the Market Accessibility Report across each country. And here, some of the issues that, we have highlighted that, make China not fully included in the index, and we need to see these improvements before any further inclusion would happen. Again, as I discussed, there are some the lack of hedging instruments in the market. The settlement cycle of China A shares is quite different from the rest of the world. It's T+0 and T+1 versus the rest of the world is different. So that can create some operational challenges. Even the holidays between mainland China and the rest of the world are different. So as a result, you may be able to trade part of your portfolio on one day and not be able to trade something on the day the China market is closed. And then last but not the least, for asset managers to be able to place trades, they have to place one trade for every account. They can't place all trades for all their clients at once, because there's a requirement that each trade needs to be placed in a separate fashion, which creates, again, a huge operational challenge for asset managers who are investing in China and helping their clients to invest in China. So this is some of the broad issues, specifically in terms of accessibility. And obviously the geopolitical tension, et cetera, is something that is overarching and something that we constantly monitor. But specifically in terms of market accessibility, these are some of the criteria that we've laid out and hope to see what the Chinese authorities do in terms of accessibility. In the interest of time, we can just go on to the Russia case study, which is the next one. Next slide. Sorry, yeah, that 24 is good. Thank you. So in terms of Russia, as many of you know, after Russia's invasion of Ukraine early last year, we got a lot of feedback from clients about the Russian market becoming uninvestable. Again, a lot of things happened then in terms of the Moscow Stock Exchange closing, clients not being able to make payments through the typical SWIFT systems. There were sanctions on individual companies. So we, launched a consultation. Again, that's a cornerstone of our process. It was a shorter time period because we had to act quickly, but we, met with different types of clients across the globe to understand their experience. And as a result, we decided to, on March 9th of 2022, we decided to delete Russia from the emerging markets index and make it a standalone index. On the next slide, what we'll see is it continues a standalone index for a while. And just March 1st of this year, we decided, since we didn't see any improvements at all, we decided to completely discontinue calculation of any of the Russian indexes. Now, just one point which is interesting to note is the weight of Russia in emerging markets before it got, before the onset was about 3%. And at obviously at exclusion, we deleted it at about 0% because that's, it meant that no one could invest. Everything was illiquid. There were no transactions being able to made. So as a result, we typically follow that process where we keep, an almost 0% price and keep it as a standalone till we see if there's an improvement. We could perhaps put it back, but we did not see any improvement. So we followed due course again there and decided to discontinue any sort of Russia index calculation. So with that, I am going to pause. I know I've probably shared a lot of information, but would love to see if there are any other questions or any clarifications.
Any questions? Mr. Kelly?
Thank you. Good morning. I wanted to just thank you for your presentation. I've always thought of index providers as kind of credit rating agencies, like they're really important, but you don't really want to know too much about how they do what they do. But you've demystified it for me today. But I did have a question for Essie. So there's obviously an infrastructure here at MSCI to compile this. Do we pay for this information? Is this like a subscription service, or how do we compensate for it? How do we compensate them for it?
All of our indices, whether they
The mic.
Thank you. All of our indices, whether they be MSCI, there's other subscriptions we have with Russell and S&P, they are paid per year. No.
Thank you.
Yeah, thank you. Thank you for having me.
Anybody else? Ms. Jones?
Good morning. I, like Trustee Kelly, am appreciative of all the information. So I just had a question. I understand that you do, connect with all of your clients, you get feedback, you have depth research, but how do you give yourself a scorecard? Like, we use your index to measure our performance. How do you, determine you're doing well? What are the parameters that you use for, benchmarking your benchmark?
Yeah, absolutely. So I think, one of the key things that we do is we look at our accuracy levels in terms of benchmark construction, and we evaluate ourselves every year in terms of that number. And I think it was in one of the first couple of slides that our accuracy level is at 99%. And for that, again, is really, really important, because if you don't have that, then clients like yourself will not be with us. They will move on to, other parties. So that is for us a key measure. The other key measure is, to be honest, and it probably sounds like I'm repeating myself, but it is the clients, because if clients are coming to us saying, we want to do this, we have a market cap franchise with you, we want to do more around factors, you want more on different indexes, they trust us, they believe in our franchise. And that to us is, it's not a real scorecard, but it is, the ultimate kind of icing on the cake that these clients want to do repeated business with us. And that's something that we've seen across the board, just with our ACWI IMI franchise, that, it's again penetrated across clients globally. And so I think that's really it. And then, of course, in the review process, as we said, we have this oversight committee and all the different committees who look for these results, who look at the processes to make sure everything is appropriate, everything is fair, the announcements are happening in the right fashion. Because trust me, if something doesn't happen correctly, we will hear it immediately from clients, immediately. So yeah, so that's I would say that's kind of a long-winded answer to your question.
Thank you. My other and final question is, how do you do succession planning within your organization to maintain that, that wealth of knowledge year after year? Because I know, the index has been around for a very long time.
Yeah, we have globally, not specifically indexes, but globally, we have about 400 researchers. And, and there are within these committees, the researchers who are on these different committees, they've been there for a long time, and they're a group of researchers. So no one person is making decisions on a particular process. So the idea is that the moment, for example, a personnel leaves, or, there's for whatever reason, there is that wealth of knowledge that is being carried forward over time. And again, for us, that is really important, because that is our IP. That's how we are viewed as one of the leading providers in the market. And that to us is, a real asset, and we keep it quite, we treat it quite preciously.
Good. Thank you for that. Mr. Fila, any questions or comments?
No comments or questions this time. Thank you.
Good. Thank you very much.
Thank you.
Presentation, we really appreciate it. Very enlightening. The next item on the agenda, when I find it, items for staff review, I didn't see any. I don't think it was any. Go to the order. We will wait to the main board meeting. I will entertain the motion to adjourn. Madam Chair, what time are we rolling?
So let's go ahead and put a 10-minute break. So let's get going at 9:05, if that is okay.
9:05. Thank you.
Thank you.
Did we get a motion to adjourn? Thank you. Meeting adjourned.